All right, and we're back with Chris. What's up, Chris? How you doing, man?
Good, Nick. How are you? Happy Tuesday.
I'm good. Happy Tuesday. You probably had a good day yesterday with the turnaround midday because I know you were selling some calls and puts, right? I think you were selling for credit, right?
Yeah, I had a little daily action in the SPX yesterday and today. Yesterday the trade was done by let me see my timestamp here. Yesterday by 10:08, today by 10:01. So
Hey,
little
very
little
nice.
daily action there in the SPX. Not a lot going on as far as price movement. We've got some earnings after market today that can shake things up a little bit. Microsoft, Advanced Micro Devices after earnings today. Things are pretty quiet. I saw that SoFi was down slightly. Pfizer I didn't take a look at. I got an early assignment on Google. I did an in the money, bull put spread, bear call spread. I traded that for some cost effective earnings, and I was assigned early on Google at
Hmm.
190. So not an issue. If I'm assigned at 190, but I have a 187 long put, 187.50. So right now, if I wanted to close out my long put and I want to take the shares, I would own the shares at 171.
Okay.
Um, so I'm just thinking about this right now. It's like, well, I think the earnings kind of hinge on what the market gives us. I mean, the reality is I can essentially wait until Thursday, Friday to take any assignment. So I have the shares right now. I still have my long put. I was noticing that today that I wasn't getting the extra time value in this option. So for me to just take the shares today doesn't really do me any good. So I'll just wait. If price is below if price is below 170 by the end of the week, I'm actually going to make $1.75. Let me change the color here. I'll actually make $1.75 on the winning side of the trade, and on the ownership and the extra put, basically the net loss would be about $1. So
Okay.
I don't have to take the shares. I don't have to keep the shares, but the net result is if we're below 170, if we're below 170 by the end of the week, then I'll make an extra 75 cents and not take any assignment. So I think I'll just sit on this for right now. Count wise, everyone's fine for stock buying power, and it's not an issue. But I went a little. I'm not going to say aggressive. I just did a bunch of credit spreads here, but let me track. So trades that I'm in. I also got my repair trades. I think we talked about this last week, Nick, on China. I took some
Mhm.
stock on KWeb,
Okay.
and KWeb is down, but I actually repaired the stock for most of my accounts. I've got one more account in here with ownership around 24. I got 42 cents out of it, so 27 right there. So I own the shares at 24.27, and I added another covered call for this week. So this would just be a quick repair. I'm trying to minimize some of the China exposure. There are trades that I still like that are China related. But for right now, I'm looking to get it called away. If it stays above $26 this week, I get it called away for $1.73, which on a few hundred shares makes a few bucks. It's better than losing, and it's just a repair. Get rid of some of the trades. And honestly, like in the stock market, this is pretty easy to do. So if anybody was interested in learning how to start out with a very simple strategy like a credit spread. Um, if you have the ability to own shares, how to basically prevent losses. I mean, you can take a credit spread. If you're willing to own the shares, it's easy to repair the stock, so you don't have to take the loss. I do that quite a bit, so it happens to be one of my favorite strategies when it comes to either collect credit, no assignment, um, you know, take the credit, take the assignment, repair the trade, prevent the loss. Just increases your strike rates and win percentages by a lot. So
Sure.
simple stuff, if you just know a couple things about trading some options. So,
Exactly.
how you doing, man?
You
What's
can do a
what's going
lot.
on in your portfolio today?
I've got some stuff that I'm doing. I'm watching gold. It did pop back up as a possible bullish setup for me, but
Mhm.
I don't love the price action. It's very choppy recently. I just don't. I feel like I love trading it when it's doing this, right? Obviously, who doesn't when it's making nice moves and you're on the right side of it? But it's been choppy, and this breakout here was a big one for me. I thought that was going to keep going after we broke through those highs. We fizzled out. I trailed out of the trades that I was in on it. So I am kind of on the sidelines with gold, but watching it. I'd love to see either a pullback to the 2300, in which case I probably take another stab. This level has
Mhm.
been really good to me over the last several months. This has been a really good buying zone. So I like the idea if it does roll over. And at the same time, if we break through the highs, I'll probably take a momentum trade. So I like gold long, but I need to see either momentum pickup or a discount comes into play. So kind of where I'm at with gold. At the same time with the indices, I'm really curious. Today kicks off. Well, I guess not kicks off. Google really kicked it off, but today continues the question that the whole stock market is wondering with the AI trade, which is, what is CapEx looking like for these big companies? Are they going to continue to spend heavily on the AI trade, which is also contingent on their earnings? If their earnings are, very good projections going forward, then perhaps the AI trade is safe. Perhaps the spending on semiconductors can still be strong. I personally think that it will be. I think that, I was just thinking about this anecdotally this morning, Chris. I was going around and playing around with AI because I wanted AI to read an article for me and give me a summary this morning. That was the setup. Then I tried like 4 different AI, different things to just see which one gave me the best answers. I used Twitter's Grok. I used Gemini from Google. I used ChatGPT. And I said, I paused as I was doing this, and I thought to myself, wait a second, none of them can stop spending, because the best one is where everybody's going to go. And they all know that, especially Google, whose search business still makes up a huge component to what they do. So I think, spending is supported. I'm staying with the tech trade, as I've mentioned, for better or for worse. I might be very wrong about this, and these prices are too high. But I don't quite see the rollover effect just yet. So we'll see, though. This is where the rubber meets the road, because if by the end of the week we see just kind of disappointment from all the big techs that come out, today we have Microsoft and AMD, as you mentioned. Tomorrow we have Meta, and Thursday we have Amazon and Apple. You have all these big tech companies reporting. My thought process is I'm going to be long. I'm gonna assume these companies are innocent until proven guilty. That's the current trend. That's the prevailing theme of this year. So I'm going into earnings season with that as my base case. But if I get surprised to the downside, I've got to admit I was, on the wrong side of that, and perhaps the trend has truly changed. But I think this week is the defining factor of whether or not this is just a pullback and a wonderful buying opportunity for the rest of the year,
Right.
or if this is the start of a bigger turnaround theme for the second half. And I'm loyal to the, to the profits first, right? So if something breaks this week, I'll probably sound very different next week, but we'll see. I'm not, the old expression I always say on the channel is hold loosely to strong opinions, and that's kind of where I'm at with it.
Yeah, it's very true. It would be. I mean, let's it's end of July, right? We've got the Fed this week. Also, don't forget about that, with Powell dropping some comments and the likelihood of the Fed rate cut in September. I still think, according to the CME Watch tool, the Fed's likely looking at 3 cuts by the end of the year. What's funny, Nick, is if the Fed cuts 3 times, so this would be September, November, December. That's actually what they said at the beginning of the year.
Wow. Yeah.
So look at what we have done as, like, we're analyzing what's the Fed going to do, and we thought it was 6 or 7, and then it's 1 and it's 0. It's like the Fed actually said like 3 cuts.
Well, and it's kind of like, Chris, when somebody gets really good at sports betting, what do the casinos do? They hire them to write the betting lines.
Yeah.
With the Fed, when people are incredibly good at economics and trying to project something that is very, very hard to project, the Fed hires them. You got brilliant minds working at the Fed. So,
Sure.
the market is all about, there's a dynamic that the Fed doesn't quite get, which is the absolute emotion that comes with the stock market, which can drive prices by itself. That's a different component that I think traders hone in on. Fed officials focus heavily on the economic data. Traders try and do that, but also hone in on momentum and enthusiasm and the AI theme. And there's trading. That's why I think trading is different than being a good trader is not necessarily being an economist. An economist does not equal being a good trader, right? There's some differences there.
Yeah, we have. Well, I mean, the rotation. Look, there's a lot going on this week. There's 900 plus companies with earnings, plus the Fed end of the month, kicking off a new month. The data pause right now is going to be Jackson Hole is August. That's about all we really have. Is we have earnings season and we have Jackson Hole in August.
Yep.
If we're looking at this rotation, I mean, look, it's going to be odd to see the Mag 7 underperform and somehow see like the Russell do well. I know a lot of traders right now are probably talking a lot about the Japanese yen. I think the Japanese yen is pretty straightforward. I said this week, a couple things to watch for. So let's just take a quick glance at the yen crosses here. You know, we had this giant drop, but most of the yen pairs move between 900 and 1,000 plus pips over the last couple of weeks. You know, looking at the currency strength today, it wasn't a huge surprise that we saw weakness in the yen, at least in the short term. Volatility is kind of expanding a little bit, but there's a lot to be said. The BOJ is tonight, by the way. So tonight to tomorrow, what's the Bank of Japan going to do? Anything? Is it still the same old, same old? I said that, you know, my look on the Japanese yen right now is it does appear to be doing some, you know, pretty severe damage to like this uptrend and putting this carry trade in jeopardy.
Mm-hmm.
But would anybody be surprised if after this sell-off from a high to a low, let me change the color here, from a high to a low, would anyone be surprised to see just the pullback, like a 30 to 50% pullback? I wouldn't be surprised to see that in the short term. I know that typically when the yen is unraveling and this carry trade is going to dissipate, that it's bear flags. So I mean, if we go from here with a pause and we go lower, I mean, I've seen this on your charts too, Nick. I mean, if we're breaking this Aussie yen trend line, any type of pullback, I'm going to take some stabs at trying to short. Now, we've
Mm-hmm.
talked about this a month ago. I'm not trading a lot of Japanese yen right now because every single day I get charged to hold that. So what
Yep.
I'm holding is I'm holding FXY,
Yep.
which is an ETF that trades the Japanese yen. And I'm also looking at the futures market for /6J. Those are positions that you don't get charged negative swap. You just trade the direction. So FXY, if I'm bullish, I want to see stronger yen with that. 6J, if I'm bullish on the yen, I would trade that long in a futures contract. So those are probably the ways that I will be trading if I'm more confident we have a direction. I think right now, look, I didn't participate in this at all outside of having my FXY long, and I'm break even. Like I
Yeah.
was in a
Yeah.
tiny little drawdown on break even.
Just to show how difficult the timing is with that. I mean, but to
Yeah.
your point though, with FXY, with the yen, going back to my theme with the Nasdaq. So this week, if earnings are very disappointing, if earnings outlooks are disappointing, or spending for the AI trade is drying up, investors are concerned. If we get some super bearish stuff, it's probably tied to the yen too, because if that changes global sentiment to be like, well, spending's drying up, earnings are drying up, maybe the risk on party is a bit over, that's going to turn into probably, I would argue, more favoritism for the yen, selling other currencies in favor of the yen. But you're making a bet that the global economy will kind of cool off or maybe even slow, recessionary, in which case the yen could be dramatic. So if we see, this by end of week, earnings are awful, and maybe the Fed is comes out more hawkish than expected. If we get that theme, the yen could look really strong as a alternative to all this market sphere. So we'll see.
Yeah. Well, I'm just first half of the year was strong. Second half of the year, momentum probability is strong. And like you said, I'm sticking with that narrative right now, and that there's a lot of noise the market delivers. I'm happy in a way. I'm happy we're getting pullbacks because we were having the same conversation when the that was weird. When the SPY was sitting here overstretched and we're hitting all-time highs, and we've got 6 all-time highs in a row. I mean, we're saying it's like, is this going to pull back? But now we have, right? And now look
Yep.
at how quick the narrative shifts of like, now we get a pullback and we're questioning the entire market.
Yeah,
Like,
whether or
can
not
we
it's
sustain
even,
these
yeah,
highs? And are we going to get back to those highs? And
yeah,
it's even, you and I that understand, like, look, pullbacks should happen. And it's just funny, like how much data gets dumped into like why we dropped 5% in the SPY, why did we drop 9, almost 10% in the Qs?
right.
Because now it's like, well, it's because it's highly concentrated and there's only 7 stocks that have been doing it. Now, if they start to show weaker earnings, it's going to drag everything down. This is
Yeah,
the house
the
of cards
narrative
we're
can
talking
shift
about.
so quickly. I
Yeah.
do think that it's, it's due for a pullback, and honestly could be due for a bigger correction. Will that be now or later? We'll see. I mean, really, this week is a big make or break it week, because if you get
Yeah.
earnings that come in really strong, the AI trade might resume. And if earnings come in any way weak, this could very quickly turn from a 5% pullback in the S&P 500 to a 10%.
Sure.
And then you really get the questions of, is this thing, completely rolled over? My personal bias is I lean a little bit more on this thing is innocent till proven guilty. I don't see the catalyst just yet for 10% plus on the S&P 500, but again, keeping an open mind. If earnings are bad this week, I will be in that camp. I will be in the, okay, probably 10%. If earnings are
Yeah.
bad, the problem is, from my positioning perspective, by then I will have already missed it. But I'm willing to miss it because my bias generally leans, I think that, tech companies they're gonna hit it, as they have for a long time. This year's been really strong. We have rate cut optimism that's kind of pieced in there. So we'll see. But if I need to adjust, I will adjust, and that's kind of where I lean. At the same time, you got gold pushing higher, silver's making a little bit of a recovery. Silver's been getting crushed, and recently, with the same thing with copper, has been another one to watch. Copper futures just getting pummeled here. So
Yep.
really interesting to see that goes against, this I think has a lot of in tandem with the yen, right? The yen strength is that idea that maybe the global economy is slowing more than what we think. Maybe this thing turns into, more of a secular like slowdown in the global economy, and maybe that's why copper is lower. That's why the yen is higher, and maybe that's why stocks are down. So I don't know. We'll have to see. Chris, I'm gonna leave you with Frank. I think he's showing up to chat with you here for a few minutes. So I'm going to step out, give you guys the floor for a little bit. But thanks for chatting with me. And also, before I step out, we just dropped a link to Chris Pulver's YouTube channel. Guys, make sure go subscribe to Chris Pulver Trading. And if you're watching on Twitter right now, it's at Real Chris Pulver. Chris, I'll leave the show with you and Frank, and you guys get after it. Thanks for coming on.
All right, we will. Thanks, Nick.
All right, man. See ya.
See ya. All righty. I think when Frank jumps on, we'll probably talk some earnings plays. There he is. What's up, dude?
How's it going?
Good, man. How are you?
Pretty good.
What are you feeling today?
About what'd you say?
I said, what you feeling today?
Earnings, of course.
Earnings.
But
Okay.
I heard y'all talking about that 10% on, was it the S&P or the NAS?
Well, the NAS was like a 9.8% correction. The S&P was a 5% correction. Nick was just saying if it was, if it got a little bit more extreme to the downside, or somehow earnings was disappointing this week, and we started to kind of, well, look, if the S&P breaks fresh lows, then that potential, 10% correction level is a little bit more realistic. So we're just contained around that 5% zone from the correction from. I mean, it doesn't seem that long ago, but about 2 weeks ago, we hit the top, and we've been dropping. So if we take a look here, this is, the last 2 weeks of trading down in the S&P, the last 3 weeks of trading down in the NASDAQ and in the tech world. So your Qs are down, NDX, NQs are down. That's 1, 2, 3 weeks in a row. And then this week starts off still red for the week, but, kind of contained, watching to see, are we breaking last week's low? Are we trying to come back and fill a gap this week? This is the question, right? I mean, 10% is pretty healthy. 5% is decent. If the S&P has the 10% correction, that's a lot, man. I mean, especially in July, like that's an odd correction time for July, but it is what it is. And like I said, it's look, I mean, heads on a swivel all the time. If you're a full-time trader, you're always taking in all this information. You're trying to do your best to digest it, block out all this noise, and just try to stick to good trades and good risk management.
Yeah,
but
I think I heard a stat about if the S&P corrects more than 4 point something percent, the trend to a lower correction is likely to happen. I wish I could find the news source for that, but so we saw 5%, which was more than, I guess, more than the range in which it could stay in. But let's see. So we went down 4.8%. I think it might have been around that. So I don't know. I think the odds might be 50-50, but I'm still thinking we see a move lower, a completion to the downside. I think NAS has, I have these two levels drawn that, wait, let me share my screen really quick.
Okay.
But I have these two levels drawn that I think it's going to test either one of these by the end of this week. So we got here 19,400s, and then we got the 18,400s or 500s. I think it's going to move to one of these levels depending on what the Fed is saying, which remains the question of, like, is he going to say anything of substance this time? I think he's going to have to if we have those 3 cuts in place on the Fed Watch tool, and we're getting closer to that September meeting. I don't think we're going to do anything this month. I don't think anyone's expecting any kind of move, but I think what everyone's looking for is his cues on, is there confidence in the inflation projection, or are we going to cut? If he mentions either one of those things, I think we're going to either see NAS come up to the resistance level at least by the end of the week if we get those dovish comments. But if he remains the same and is not saying much, then I think it's just going to depend on earnings.
Well, okay, so let's talk inflation for a moment. I know this is not the core PCE. This is not the CPI. This is not the typical round of inflation data that we get out of the U.S. But this is a third-party Trueflation. I do monitor this simply because this at least shows a trend direction. And so even when we had this sticky inflation around, like, Trueflation was at low 2s while we were getting readings on the CPI year over year at 3s. So now this is actually broken into some fresh lows. We're getting, Trueflation showing a 1.54% inflation, in, U.S. government rate pointed at 3%. So, again, I don't know what Powell says tomorrow in the press conference. I would imagine that the tilt is going to be towards job data of, look, the job market's been softening, to a point that's probably raising some flags. Housing is essentially paused right now. Without cuts, like, the housing market is going to be stagnant. Without cuts, the labor market's going to be struggling. Without improvements in inflation, the Fed's not going to cut rates. So, I mean, obviously, it all kind of works hand in hand. The Fed has certain mandates they're sticking with. I think right now the labor market and having full employment is probably more important than inflation, because inflation is doing what they expected it to do, which is softening. So, again, it's all depending on the language. And I'm not sure if you guys are running a live session for FOMC tomorrow and you're going to digest, all the little comments from Powell, but it's always tough to read. Price action to me is what ultimately, lets things open up. And when we come into Wednesday to end the month, I mean, we do have some earnings right after market. So, I mean, Powell could be talking at, 2:30 to 3 o'clock. After market, you've got Qualcomm and Meta. Meta's at least a top 10. Thursday is a big one with Amazon and Apple. Look, I think the Fed in a way could justify some price action to bring things back up. I don't know why the market would be so excited to, rip now in July, other than the fact that, okay, we've had a pullback. The Fed's pretty clear on the language that they're going to cut rates in September. And then you wonder, if they cut rates in September, everything looks good for November and December, and we're right back on board with having 3 cuts by the end of the year. And maybe the market likes it. So it's a weird spot, Frank, to be honest. I mean, this little 9 to 10% drop on the NASDAQ, it doesn't have to stop right here. I think that's the reality. Is, like, I've said this in a lot of videos I posted in the last couple of weeks. I mean, if all this is after a crazy big trend and completing a 5th wave, if all we see is a 1, 2, 3, I mean, look, I could see this week's price action actually pushing higher, but being the old dead cat bounce where the market's fading that rally for one more correction. So you had mentioned 19 You mentioned 19.4, and then you mentioned 18.4. Do I get those levels right?
Yeah,
roughly. Okay.
pretty much.
So is that where you're looking? Is like we can, make a run up to 19.4 or make a run down to 18.4?
Yeah. So I wouldn't know honestly how to trade it if it went up to 19.4 because
Okay.
I think I'd be looking at what's going on in FOMC, what happened in earnings, and are we going to see a break above, like a breakout and then a test at the highs again, or are we going to
Right.
see that what you call the dead cat bounce?
Right.
So if it's not confident and we see this rally, maybe I'd look to take a short play on it at that level. But if it's good news, if it seems like good news to me, I probably will maybe take a long. I don't really see it coming back up, at least the highs. I mean, it could come up to this level like we were talking about, but I'm just not very confident in it.
Yeah,
It's got to go further, in my opinion.
I think look, I think just turning right around after. I mean, we've had what? This has been 3 weeks of selling in the Nasdaq, and to say, okay, we have a 3-week sell-off that equates to 10%, and then how long does it take for that 10% correction to be an 11, 12% comeback to get to all-time highs? What's going to justify it this time? You got to wonder, how much is the rate cut scenario priced in? I mean, it felt like, well, the market's pricing in for a rate cut in September, and that's what ultimately justified this like final push. And so, I think there's going to have to be other things to justify all-time highs. Yes, there's momentum. Yes, there's an election. Yes, there's history of election years are typically pretty bullish and not a lot of disruption. We've had one of the better starts this year than ever before. It's like top 15 all time. One of the best starts to an election year ever. First half momentum is strong. None of that matters. It's like there's no set probability of 100% in anything when it comes to trading. So, look, I'll tell you exactly what I'm doing. So this week, I took a couple of angles where I'm trading some earnings, and that's fine. I'm doing some really simple trades where I'll just bring up my spreadsheet here. So I am in. I've got a black swan hedge on the NQ, which is that's the futures feed for the E-mini Nasdaq. Okay, so it cost me $1,000, and I've got a $19,000 profit payout if it happens. I did it out to October. Apple, I'm looking for a bull put spread as a trade around earnings. Amazon bull put spread around earnings. MicroStrategy. So fundamentally, that company is actually terrible. I'll show you this. I've seen this before, and I just kind of reaffirmed it yesterday. But if I go to MSTR, I mean, look, I know that MicroStrategy is sitting on like $5 or $6 billion worth of Bitcoin. I know that, but it doesn't reflect in their fundamentals. So right here where it says has less than 1 year cash runway, currently unprofitable, not forecast to be profitable, shareholders been diluted, volatile share price. If I see a stock like this in a simple snowflake analysis, I am not touching this stock. So the problem is you have to almost evaluate MicroStrategy on the fact that it does have Bitcoin holdings and what that look like. What does that look like for the stock long term? And look, if you're a believer in Bitcoin bulls, then MicroStrategy is a good play. But when it's not reflected here, this is another thing with discounted cash flow. Current price is 1684. The fair value is 782. I have no interest in owning MicroStrategy longer term outside of having some Bitcoin exposure, which I think is totally fine. But for this individual stock, it's like, I guess until they're merged together where this is getting more credit for, like, if this says has cash runway of less than 1 year, and then in parentheses says, but has $5 billion worth of Bitcoin holdings, it's like, well, I mean, if that means something, then this should be a different analysis. So my point is, I like MicroStrategy from a, kind of a crypto exposure. This looks very similar to what Bitcoin's chart is. I've actually had some pretty good trades on this year. When we had, this correction, I did some broken wing butterflies. We had this correction, broken wing butterflies. It's an expensive stock, so this isn't necessarily one that I would hold outside of fractional shares. I mean, I'm not going to take 100 shares at $1,600 and tie up all that capital. What I would do instead is, I could throw $2,000, $3,000, $5,000 at it, buy a couple of shares, have that appreciate, just have the dollar amount appreciate as opposed to owning shares. But the problem is I own the shares at fractional
Why not
ownership.
just put that money into Bitcoin if you're long Bitcoin?
That's my point. It's like that's what I'm going to trade. And that's why I am trading. So, and also the reason that I'm just talking about MicroStrategy is because it actually outperformed Bitcoin in a way. This rip to the upside from 500 from this recent run 500 to 2000. That's up 300%. I don't think Bitcoin had the same type of love. Bitcoin wasn't up 300%. If it was, okay, I stand corrected. But anyway, it's not something I can trade. So look, when I trade options, that's how I like to trade and own shares. Is I want to control options. If I'm going to take assignment, I'm very I'm lowering the cost basis all the time, or I'm using leverage with options as opposed to just buying shares outright. So for me, I mean, I'm just going through the summary here. But if I'm going to buy MicroStrategy, maybe it's down here at $1,200, maybe it's down here at $1,000, but that would likely mean that we have a pullback in Bitcoin. So if I don't want to trade MicroStrategy at all, then I'll just trade Bitcoin. It's pretty simple.
Yeah, I'm I have some BITO. I have that. I think I told you I have a bull vertical, call vertical, or whatever you call it.
Yep.
For March of next year.
Okay.
And it's just been up and down.
Yeah.
Nothing crazy. I think right now it's up 23%, but I mean, this morning it was down like 15. It's just moving a lot, but it's I bought a call at 20. I sold one at 29. So that's a $9 spread.
Okay.
I paid 180 for it.
Okay.
So I could make like 720, I guess.
Yeah.
Total profit.
That's good.
So that would be nice, but it's not a huge play. It's just a longer term goal thing. I have other plays. I'm more proud of this. So I sold a call vertical on the Qs.
Okay.
I sold a call at 468, bought one at 469 for 31 cents. And this was one day out. So right now I'm up 60% on it. So if we close today below 468, then I'm going to take the 31 cents, which I like because it was only one day out and 30 cents wasn't bad for that. Because remember we had a talk where I was doing like 13 cents one day out.
Yes.
And you're getting on to me about that.
Well, I mean, it just based on capital efficiency and reward to risk. It's like if you're sitting on a trade for a day or two or three, I mean, I say that because you take one of those trades and you win, you take one of those trades, you lose, you have to take 10 winners to make that up. Right. So that's all I'm saying is, so yeah, I mean, the rule of thumb, just so you know, anytime you're taking credit spreads is a third of the width or better. So right there, you're right there. You're right in like textbook mechanical, third of the width on the credit spread for $1 spread. You're taking 30 cents credit. It's pretty good, dude. That's totally fine.
Okay.
So, and so you took this for when? When's this expire?
Today.
Wow. Okay. Nice. That's really good.
I think it got close. Like yesterday, it was at 468. So I think that's why the credit got a little.
Yeah, that's okay. This is really it's kind of misleading because it seems, I look at this and this is kind of funny, right? Like looking at the SPX or the SPY. Let's go to you did the QQQ. It looks like the market is like, oh my gosh, what a boring week. But it's almost like you have the consumption of just like these massive 2 weeks that we've had with these huge sell-offs. And so this week is actually kind of normal. I mean, this is up 468 highs to 461 lows. That's already a $7 move, which again, nobody's going to get excited about it because the Qs average around $12 to $13. But in the backdrop, you have two just monster weeks in probably 20 plus points each. So that's 27 points. That's almost 2.5 times the normal weekly trading range. And then you match that again with another aggressive sell-off at 28, almost 29 points. So in a way, those are outlier type years, or those are outlier type weeks where Actually, you know what? I've got an interesting stat here. I found this article yesterday. Let me see. I think it's SPY Stats. Yep. I thought this would be interesting. Just to put some things in perspective. So, well, I had it open to close. There it is. All right. So everyone wants to know, look, I'm probabilities through and through when it comes to trading. You can see if you put this into like some type of histogram, it's like you've got your if you do it this way and the histogram is vertical, let's say you've got negative 10% on the instrument and then a positive 10% in the instrument, and this would be the distribution curve, right? Most of it's going to be, let's say this is 0. Okay. Most of what we trade on a day-to-day basis in the SPY or the NASDAQ is going to fall somewhere in the distribution of here. Does that make sense? Like, this is just, little statistical stuff here. Most of this is going to fall within, 1% to the downside, 1% to the upside. That is mostly what we deal with, right? So this is why, yes, you can have outliers, and yes, you can have those big, crazy, wild days, and oh my gosh, a 2 to 3% day. It's so rare to see it, but when it does happen, it's, it's incredible. It's incredible if you're on the right side of it. It's awful if you're on the wrong side of it. But at the end of the day, it's just how well do you manage risk.
So if price were to move 1% either way, say like by midday, you could go, all right, I'm gonna sell some options here at wherever this is, because it's unlikely to go lower, or at least stay lower.
Yeah, you're looking at about I think I posted this. Let me see. Did I post this in my Telegram or Twitter? I posted this somewhere. Let me check. I got it somewhere. But basically, you're like you said, the negative 1% to the positive 1%. Those days are gonna incorporate about 77% of the moves. That's a lot, man. I mean, you talk about just trading with simple probabilities. 77% of the time, roughly, you're getting max 1% upside or max 1% downside. So yeah, I mean that's a solid trade. It just depends on how that plays out. Having defined risk versus if it's defined versus undefined, very different results. I mean, if you had a 1% move, let's just say that the market comes up 1% and you decide to actually short a stock on margin. Well, that's a terrible decision, right? You decide to, put in a naked call. That's a terrible decision. Those are undefined, those are undefined trades. But if you just did a bear call spread, you're at the money and price goes and stays below that line for the rest of the day. That's fine. Maybe you can grab your 1/3 width and grab your 30 cents, 35 cents for the same day. So anyway, there's just interesting ways to do it. But think about the distribution curve. My point is, most of this stuff we're seeing in a day-to-day market is going to be within 1%. 1% up, 1% down. A lot of times we're finishing at 0 or flat. And that's a lot of where I live as far as day-to-day trading or trying to generate some short-term income. Those are the probabilities that I trade a lot. So I think it's important that traders understand that. Everyone thinks like it's just, the market goes up all the time. It's like, I mean, it finds a way to go up all the time, but how it gets there, I mean, think about how many weeks we've had this year where nothing happened for multiple days and then it was a gap higher. And so, Frank, this could be a similar week where Monday, Tuesday so far, Qs have done next to nothing, but we have big earnings this week. So would it surprise you to see, a gap lower if earnings are bad? Would it surprise you to see a gap higher if earnings are good? There's still a gap up here for the last couple of days or the last couple of weeks. We have two massive gaps that were it's almost like the week just repeated, where it's like, oh yeah, nothing happens, then big gap lower, pressure to the downside, big gap lower, pressure to the downside. So I don't know. I mean, pressure's certainly on. We could come back and try to fill some gaps if we have optimistic earnings and good reports. But yeah, I'm just not sure. So I think defined risk is good. I think we plan on probabilities, and the market seems to be a little bit more normal, if you will, where we're not trading based on these two big outlier weeks. And we'll see how things get kind of contained with earnings season. So yeah, Brent, you got that. So it's just you can just search me on YouTube. YouTube.com/Chris Pulver is my handle. Easy to find me.
Yeah, that's a really good point, actually. Just trading within those high probabilities.
Yeah.
Trading the 0 DTEs are I feel like some of the best moves when you're talking about selling options and collecting premium. But
they can be, and so there's a little catch with the 0DT stuff when you're selling. So I've been doing this a lot, like the last, since like early June. I've been doing these like daily strangles. I'll put that back in just a second. So I've been doing these daily strangles right here, and I mean, if I just look at let me just check the wins here. I think I'm pushing close to like 90% win rates right now. So I have 28 wins. Okay. And I have 9 losses. So 28 and 9. So
were the losses fully?
Nope, they were fractional. Okay. So I had one full loss, and that was a very quick lesson of like, well, I'll never do that again, and I'll explain. So 28 plus 9, so I've got 37 total trades, 28 winners. So 28 divided by 37. Is that right? 20. Okay, I did take a few more fractional losses. So all right, so 76% win rate. I'm not in love with that, but I will say this: the losses right here over the last couple of weeks when we had the market selling, we just had big directions, right? So price is volatile, IV's higher. I did collect a little bit more premium. Noticing here, like 355, 375, 380, a lot more premium up front than I was getting recently. And I knew that was some risk going into this. We were at these really low implied volatility levels, really low VIX in general, and that's your implied 30-day move on the S&P. So, I mean, I knew that I was taking less credit, and so the sensitivity of 0DT as things can change really, really quickly. So, over the last couple of weeks, I mean, yeah, I strung together 5 losses, but those losses were contained. And so, just so you know, how much? Well, if I collect $3, let's just say I take in the trade and I collect $3.
Do you do that usually, or do you close out before you reach full credit?
I never go after full credit. I go after 15% credit. So gotcha. I'm trying to take a 15% profit target. It's about historically speaking, I'm trying to think over how many trades. It's at least running back. I mean, I back tested this thing for almost 2 years, and it averaged like 92% wins. So what I decided to do with my add-on is I have to cut the losses early. So for example, this was a full loss, and this one sucked hard because I took a trade for $2 of credit, and I'm taking a full loss because it never hit my 15%, and I took a full dinger at minus $1,700. So it was actually minus like $1,600 because I collected the $2 up front, but it stung. My point is, I changed that real quick for the trading that I've been doing, and now like this morning, I took the trade for $3.55 credit. I calculated the 15% take profit, and all I needed to do, and this is what's nice about the trade. I take the trade, I collect $3.55, I put in a debit to close the trade at $3, and that got filled. So I made $55 today on a 1 contract trade, and it was over in about 30 minutes. So it's quick. But I will say that if you're watching these trades, it does behave like 0DT does, which is it's very Greek sensitive, right? So your time is sensitive, your delta, your direction is sensitive, your volatility is sensitive, and so it's not a bad thing because you get like this. I still like I will support 0DT all day because if you want to learn how to trade options, if you get into observing 0DT environments, you will see what options do. And instead of waiting for 30 to 45 or 60 days or waiting for leaps, you see it happen in a day. And you can see that huge waterfall, that huge theta decay. And look, smart professional traders sell options. They usually sell options. I'm mostly an option seller. When I buy options, I'm trying to make it cost effective. When I buy options, I try to give myself more upside than downside, because there's still a statistic out there that like 70+% of options expire out of the money and worthless. So for all those long option traders out there, you're trading against an uphill probability, which is most options expire worthless. So that's the trade-off. But my point on this is it's been better. The rule that I set is basically by noon, I'm out of the trade. I don't want to hold the trade past that. So if I'm not to my profit target within the first probably 30 to 60 minutes of trading, then I'm monitoring. But is direction going to kick in for the day? Like right now it's 11 a.m. and we've had a little bit of a drop. I mean, the SPY from 547 down to 543, it's down. I mean, it's almost down about $4 on the day. And the the SPX, that would translate into some points as well. It's probably going to be 30 to 40 points down, right? So from high to low on the day, I centered this around 54.80 this morning, and so it's still down and contained, but we've gone from 90 to 50, about 40 points down, like I said. So I'm centered in a way where what were my legs this morning when I took the trade? Go back to this real quick. So I sold the 54.40 put, and I sold the 55.15 call to collect $3.15. Now, full disclosure, I'm taking that sell trade. Those are my sell legs. I'm actually putting a spread on that because it's the SPX. I'm not tying up, $1 million in buying power to trade a naked strangle on the SPX. I'm actually creating a synthetic strangle with a spread. So if none of that makes sense to anybody, believe me, I'll share more on this.
We'll have to talk about this more into your strategy.
Yeah.
At some point later, because we have Nick Phillips coming on.
Okay. Well, just to quickly recap, I mean, directionally, we're getting a little bit of movement to the downside. I'll wrap up with this. So tonight, if you're paying attention, tonight there's Bank of Japan. We have some earnings today after market. Tomorrow's FOMC to wrap up the month. Things are just getting started. They're just warming up. So I'm curious to see as we come into tomorrow's session, what's the Japanese yen doing? I think short term it makes sense that the BOJ doesn't really change anything. Maybe stabilizes that recent sell-off. But if more Japanese yen strength is kicking in, if you look at this currency strength chart, what just happened? Q's just got filled. Oh, I got filled on a 460. Okay. Sorry, real quick. I just got filled at a 460 by 459 credit spread on the Q's. So I took that trade pending this week, and I'm looking to see if we just kind of create a line in the sand. I'm pretty sure those are what just got filled. QQQ. Sorry, and I'll let us go. Sorry.
Well, we're at 459 right now. We're 460.
Okay, so I got filled at a 460 by 459 for 45 cents. I'm kind of defining that as, look, if we have positive earnings to stabilize this, I'm looking at this as a potential. I might regret this, but QQQ, based on this little sell-off, if we don't take, and this is what's going to be important, if we don't take out last week's low, that's going to be important. So if we have a sell-off today,
a crazy move.
Just the last like 5 to 10 minutes is a crazy move, right?
Yeah.
Yeah. So anyway, I will be watching. So my point is, I'm taking the trade. It's a credit spread. It's not a big deal. But if we bounce off of last week's low, don't close below it, and we stabilize here, then I'm looking for the Qs to stay above 460 and make a couple bucks. So more on that to come. But all right, Frank, sorry we went long, but thanks for jumping on, dude. Let's do it again tomorrow.
Yeah. Thank you.
All right. Thanks, everybody. Nick Phillips is up. See you.
Bye.
Welcome everybody to this portion of the A1 Trading Show. My name is Nick Phillips. We're going to be going through some currency stuff this morning, looking at the DOXY and some of the other major currencies in the world. May tap in on gold and some of the indices as well. If you guys have any questions, feel free to drop them in the chat. Now let's get going here. So earlier this morning, about an hour ago, we had JOLTS job openings, and I believe something else came out. Yes, consumer confidence. So JOLTS and consumer confidence both giving the dollar a bit of a boost at the initial release, though that boost has since sort of, I don't want to say it hasn't been completely faded. A complete fade of this this little boost from JOLTS is going to happen after we pass back below 104.67 area on the DOXY. Personally, I didn't even bother trading this event. We have FOMC tomorrow. jolts in consumer confidence. Not that it doesn't matter. Obviously, it can push the market around a little bit, but to me, it just was not worth the time. I did not anticipate trading anything US dollar wise until FOMC happens tomorrow. So completely avoided this trade this morning. Something that is interesting about the Doxy for me this week. Now, I should preface this with saying I haven't traded all week because I'm waiting for FOMC. There was no data yesterday. Jolts in consumer confidence wasn't important enough for me. So I've really just been exercising patience and discipline and staying away until my ideal opportunities start to hit the market this week, which they all kick off tonight with Australian dollar CPI, and then tomorrow with FOMC, unemployment data on Thursday, and then NFP on Friday. Those will be the most important. And then, of course, the BOE. I'm not going to be trading the BOJ rate decision simply because the BOJ is incredibly unpredictable. Forex Factory, I don't even think, says when they're going to release. Let's see. Yeah, so tentative on the monetary policy statement, the policy rate, blah blah blah, because the BOJ just tends to kind of operate on their own schedule. They don't really let the markets know when they're going to be releasing stuff. They just kind of release it, and then the markets are like, "What the heck just happened?" So, I tend to not trade anything Bank of Japan wise, but we will be trading Australian CPI tonight. Now, let's go back to what I was saying about the Doxy. The interesting thing about the Doxy for me is the strength that is still holding. I am still neutral on the dollar. I was saying this recently. My reasoning for my initial softness on the dollar, wanting to see dollar downside, is the softening economic data that we're getting and the market beginning to price in September rate cuts. However, my upside bias is truly based on geopolitics, with a potential Trump victory potentially bringing about an inflationary scenario here with the US. So a little, I guess you would say, torn. I don't like to get involved in things when I can give a solid bias for both directions. And by solid bias, I mean a solid fundamental bias. I tend to stay out of anything that would be technical only. And by technical only, I mean I jump on here this morning and try to grab a scalp in one direction or the other. I can create a direction, or I can create a bias for both directions with pretty equal conviction right now. So I tend to avoid those kind of opportunities and just wait for economic data to present itself. So neutral on the dollar. However, the dollar has breached a level of resistance that for me was a pretty strong indication of relative strength or weakness for the Doxy. Now, beyond this, my next level of, like, I don't want price to break this level, because I'm neutral leaning bearish. I'm neutral leaning dovish on the dollar. Now, I've been reading some stuff recently from Goldman Sachs and Bank of America, and Bank of America specifically is bullish on the dollar. They have some of their reasonings are they don't believe we're going to get a rate cut till December, which is absolutely insane. They are counter the entire trading base of the CME, which is right now pricing in 100% rate cuts in September. There's not a single, like, less than 1% chance being priced in the market right now that we're going to be at these same interest rate levels at the September meeting. So Bank of America is saying, yeah, we know the market's pricing that in, but we don't even think we're not going to get a cut until December. We're not pricing in a cut till December. Now, what they have said is that data in between now and December, data could come out that could change their mind. Continuing softness, significant softness, or weakening in the labor market. Continuing, they said the same, a repeat of the last inflation print. So we don't even have to go lower. We just have to repeat the last number for inflation. And one other thing, I can't remember exactly what it was that they said, but basically 3 factors coming out could lean them to change their mind about a December cut. And in regards to that, it would be continued weakening contractionary economic data would lead the Bank of America to start pricing in or start believing in a rate cut happening sooner. They didn't say whether or not they would think that it would happen in September or whether it would happen in November. But they said that something continued contractionary data will make them leave their December bias, essentially. So it's interesting that Bank of America is so bullish on the dollar, especially when the rest of the market seems to be relatively dovish when it comes to looking at fall monetary policy. And they think that the markets are overpricing it, which is fair, or not overpricing it, but over anticipating a softening cycle. It's fair. There's a lot of things that are, challenging the rate cut cycle idea, not just geopolitically. But if you go look at, there's something that's really interesting that I saw this morning from Zero Hedge. We'll go check out this post right here. This is really, really strange. If you remember from what I was saying earlier, we had JOLTS job openings come out hot and consumer confidence came out hot as well, which, is just showing that ultimately it's a bullish signal for the dollar. However, when you peel back the curtain on the job market, we just have to look at this one picture that's kind of like, ugh, it's a little weird. The government job openings have spiked incredibly, while private job openings are at a 6-year low. So it sort of begs the question of sort of what's real. Like, not that government jobs aren't real, but which one of these job openings does the market take as a signal for dollar strength? And it sort of makes sense if you think about the way that the Doxy is reacting right now. We had this big push up at the initial release because the initial release came out hot. But when you pull back the hood on those numbers and you go, oh, wait a minute, it was government jobs that kind of boosted that number. That it kind of makes you. I think that's sort of what's making the market go, hold on. We started pricing in a good JOLTS number. But then once we pulled the curtain back, that was really all government jobs and not private sector. So how do we think that impacts the value of the assets that we're trading? How does that impact the dollar? Maybe not as strongly as if private sector and government jobs were up, or even if it was the opposite. If government jobs were down and private sector jobs were up, I could see the bolstering of the dollar, this conviction continuing more so than it has. Let's see. How do I see odd USD at this point? We have CPI tonight. We had 9 daily bearish candles in a row from July 15th. Extremely outlier occurrence. All right, so let's do one thing. I'll answer that question. Let me check the Doxy real quick. So 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, I was just checking the Doxy activity in the last 9 days. Let me go check Australian dollar USD. Yeah, that's kind of crazy. So for me personally, let's see what the Aussie expectation is. Year over year, they're expecting a little bit warmer, and quarter over quarter, they're expecting the same. Off the top of my head, I'm trying to remember how the Australian dollar, or how the most recent Australian, let's see here. We're gonna rely on good old AI to give us a little bit of market research information here. What was the general consensus of the most recent RBA monetary policy meeting? Okay. Inflation trends. Inflation is still above the target range and is proving persistent despite a significant decrease. Slowed recently. Headline inflation. Economic. Okay, remains highly uncertain, although there has been some improvement in global economic conditions, particularly in the U.S. The RBA central turning to target policy stance. Okay, I'm gonna ask it one more question, and then if it doesn't give me the answer that I'm looking for, we will go consult the actual. Okay, so how can I say this question? How did the tone of the most recent RBA meeting change from the prior meeting? Did we lean more or less hawkish? Or the tone of the Reserve Bank of Australia's leaned more dovish compared to the slightly hawkish stance of May 24th. Okay, so I knew there was something in my head that was going. We switched from one to the other, and I could not remember what it was with the RBA. All right, so now let's go. Let's go check the actual RBA website. Boom. All right, so that's June. Let's check May just for. All right, so something I do whenever I'm looking at monetary policy statements, I tend to work backwards. I find a lot of the forward guidance to be in some of the last few paragraphs. If I'm trying to like get a real quick consensus of things. So let me read through this real quick. This is May. Recent data indicate while inflation is easing, it is doing so more slowly than previously expected, and it remains high. The board expects it will be some time before inflation is sustainably in target range and will remain vigilant to upside risk. The path of interest rates that will best ensure the inflation returns to target in a reasonable time frame remains uncertain, and the board is not ruling anything in or out. The board will rely upon data, and doing so. Okay. Okay. All right. So there's some hawkish tones there, like ChatGPT said. Okay. And then this is June. We have some of the same Let's see. The economic outlook remains uncertain, and recent data have demonstrated that the process of returning inflation to target is unlikely to be smooth. What did they say here? The economic outlook remains uncertain, and recent data have demonstrated that the process of returning inflation to target is unlikely to be smooth. Literally word for word, the exact same statement. Let's go see where it changes. Returning inflation to target within a reasonable time frame remains the board's highest priority. This is consistent with the RBA's mandate. The board needs to be confident that inflation is moving sustainably towards the target range to date medium-term expectations. Inflation is easing, but been doing so more previously than expected, and it remains high. I believe that's word for word the exact same thing. Almost. Recent data indicate that while inflation is easing, it is doing so more slowly than previously expected, and it remains high. For whatever reason, that feels like a mouthful today. It is doing so more slowly than previously expected. The board expects it will be some time yet. The board expects it will be some time yet. Okay, so I'm trying to see. I feel like there was one sentence here that changed at some point. It has been like a week or two since I looked at RBA stuff. So my in May, the RBA expressed some concerns about persistent inflation and maintained a readiness to adjust the cash rate. They noted it is doing so more slowly than expected, strong domestic cost, blah, 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 blah. By July, the tone shifted as the RBA acknowledged that recent data showed inflation continuing to decrease, albeit gradually. They maintained the cash rate and emphasized the need to remain vigilant, but noted that the path of interest rates remains uncertain. The board highlighted mixed economic data and the importance of medium-term inflation expectations staying consistent with the target. The softer tone suggests a more... Okay, interesting. Yeah, it looks like basically the exact same thing. I'm trying to see the difference. I believe... I remember there being a difference, but right now I'm not able to find where it was. Where is the softer tone? That's what I want to know. Where the softer tone is at. Okay, so let's do this. What specifically indicates a softer tone between the two meetings? In May, the RBA expressed concerns about persistent inflation, noting that while inflation was moderating, it was doing so more slowly than expected. In July, they acknowledged that inflation continued to decrease gradually. They recognized that while inflation was still above target, the pace of decline had slowed, indicating a less urgent tone regarding the immediate. In May, they highlighted significant uncertainties regarding economic outlook. They recognized the uncertainties in July. The tone was more measured, emphasizing the potential. The board emphasized the need for sustained vigilance, but did not indicate an imminent need for rate hikes. Maintain a readiness to adjust it. Blah, blah, blah. More neutral with a focus on ongoing data assessment. Was that it? I think they had shifted from... I think that's the answer I was looking for. They had shifted somewhere in the verbiage about potential rate hikes to assessing the data on the dovish side, if I remember correctly. Regardless, as far as AUD USD goes, for me, I'm not looking. This is tough because on one hand, sort of dovish, bearish on the dollar. Long term, bearish on the dollar. And I might be proven wrong in the coming weeks. It just depends. the dollar's in an interesting place right now because of the conflicting situations in the economy. However, let's take just the Australian dollar into account. For me, I would like to see, just mark a couple levels here on the daily, and then we'll drop down. For CPI tonight on the Australian dollar side, because we are experiencing some dollar strength, and we don't have FOMC till tomorrow, so dollar strength is still a viable play until I think the Feds come out and say differently, if they're going to say differently. So I would love to see CPI come out cooler than expected, especially because the forecasts are hotter than expected. So if we get a cooler than expected Australian dollar CPI tonight, the markets are already expecting a hotter than prior. So they're expecting some heavier inflation to come out. If we get a surprise scenario where inflation is actually significantly cooler than forecasted, plus if the Doxy strength holds up through Asia session, we get a significantly weaker surprise for the Australian dollar, combined with the current dollar strength, odd USD to the downside further. And depending on where our positioning is at going into that data, you're looking at 645, 650 as targets. It just depends on where we're at. Anything could happen. We have, how many more hours do we have left until the news tonight? Like 9.5 hours, almost 10 hours. I think maybe right at 10 hours until the news. So we still have 5 more of these candles to play out. You have no idea where positioning could be ahead of the data. But if we stay here, if we stay in this little zone here, it would be ideal, to be honest. And then we get significantly weaker Australian dollar news. Boom. We break out below this level here, sell to the downside. That's going to be my play for the Australian dollar CPI tonight. Yeah, Christian. Yeah, I definitely. I don't know if you're talking to me or if you're talking to the other Nick, but yeah, I only trade futures. I mean, I still have CFD accounts, but I started trading futures at the beginning of this year. I've been trading CFD since 2017, and after making the switch, it's like I'll never go back. Why did JPY? Someone asked, why did JPY pairs drop about 15 minutes ago? So we got some strength in the yen out of nowhere, but I'm not seeing it. Wait, let's see. Oh yes, I am seeing it here at 11. Let's see. Bank of Japan to consider additional interest rate hikes, including interest rates to around yen pops on NHK sources piece on potential BOJ hike to. So NHK, let's look up this. Who is NHK? This is the first time I've ever come across NHK. Okay, so that's Japan's broadcasting. Their like main broadcasting service. Okay, so let's see news. Latest news 6 hours ago, 4 hours ago, or something that happened 15 minutes ago. NHK. Oh, great. All right, can't read any of that. Let me consult one other thing. Yeah, as far as the yen pairs moving, it looks like it was this NHK headline. I can't find where it dropped initially other than 1104. But this thing, oh yeah, this thing popped right at 1104. Okay, so there we go. The Bank of Japan to consider additional interest rate hike. So they're looking, as opposed to raising, I believe the outlook was a 0.1% hike. Now it's gone up to a 0.25% hike. So that explains the yen strength there that kind of came out of nowhere. The market dropped because of jolts. As far as equities are concerned, possibly. I don't have a real intuitive sense about how jolts jobs data and equities sort of interact. I would say, the most my initial thinking would be yes, that equities would drop because of jolts. However, I believe jolts pushed them pretty low, but I don't know if all of this weakness could be attributed to jolts, because if you also look at the doxy is trading almost back where it was when the jolts jobs data released. I would feel more inclined to attribute the entirety of the equities downside move to jolts if the doxy had not already recovered the entire release. So it could be some jolts. It could also just be the continued rotation out of the bigger stocks into small caps. I don't have that data in front of me. I don't look and assess that data. But that's tends to be the general idea right now, is that everybody has been on this rally with equities to the upside for, I don't know, however long it's been, a couple months now. And now we're getting this significant move to the downside. NQES, I believe Dow 30 as well. And it's sort of, the idea is that all these participants that were getting involved in these bigger names stocks are now rotating out and getting into smaller cap positions. How will I play ADP? I'm not going to trade ADP tomorrow. So I actually tend to never trade ADP. I look at it to see what it says, but I never actually trade it. It's not one of the most impactful events for me. So I will be trading FOMC tomorrow, and the Bank of England rate decision, and U.S. unemployment, and U.S. NFP. Do I think the Fed cut can possibly happen in a few days, or would it take a few months? I mean, can possibly, those are very important words. Anything is possible in the markets. The Feds could come out tomorrow and say, we love everything we've been seeing out of the data side. It's time to cut. We're going to cut today. They could surprise the markets. They're not likely to. I don't believe that that's the most likely scenario. I think that's the least likely scenario, like absolute least likely scenario. But as far as possibilities, it's a possibility. My sort of idea about the Fed's cutting is it's being challenged right now with election season. This is an interesting time to be trying to analyze the markets and create any sort of forecast, because you have this looming sense of uncertainty about the US election. So, as far as one, I don't think they're cutting tomorrow. Absolutely, I don't think that that's happening. I would love to say I think we're going to get a cut in September. I could see the September meeting being another kick the can down the road meeting due to the Feds not wanting to seem politically motivated, you know. But it's tough because it's if that's their outlook, it could also be seen as waiting for the election to happen, could be seen as politically motivated. Well, we're going to keep rates high during this one party's presidential run, the Democrats. We're going to keep rates high for them. And then if we get a Republican win, we're going to start cutting rates. If we get a Democrat win, well, I don't know, maybe because you can't really control the outcome of I don't know. It's tough. The election is tough. It makes some of this stuff a little bit more nuanced as far as creating any kind of forecast. I'm inclined to side with the rest of the market and say September. I'm inclined to want to believe the Feds when they say that they're not taking any political stuff into account. But I could see September being a kick the can down the road. Let's let the election get past us and then make some decisions on monetary policy. So more sell off tomorrow since Feds won't cut, but it is now priced in, you think? More sell off tomorrow. Personally, I would love to see dollar weakness out of the situation tomorrow. I would love to see this kind of push up on the doxy be challenged and us continue to cut. Absolutely. But it's just going to it's going to come down to interpreting what the Feds are saying. So what is the tone of the overall monetary policy statement, right? And something that you guys can do if you don't know how to read the monetary policy statement is what you can have this loaded up. Federal Reserve. And I believe it's going to publish on the press releases right here. Let's just say we'll go to the monetary policy for now. Okay, so recent documents has got the FOMC statement from June, right? So on the news and events, the press releases is where it should drop for tomorrow. Go ahead and have it loaded up. You can take this document. Is this the whole thing? That's not what I wanted to see, I don't think. All right, so we'll go to the press releases on monetary policy. Minutes. Boom. Okay. So this is their FOMC statement. We'll just copy and paste this. Go copy, go over to ChatGPT, say, tell me if this leans hawkish, dovish, or neutral. So maybe copy that. Let's see. Let's do this. Tell me if the following statement leans hawkish, or dovish. Boom. The statement leans hawkish. Boom. So, it helps to have a little bit of understanding for yourself about some of this. And that way you can kind of fact check the AI. Let's see. The statement mentions that economic activity has continued to expand. This suggests the economy is robust. Inflation is eased. It remains elevated. There's been modest further progress. The decision to maintain the target range for the federal rates, blah, blah, blah. Inflation, highly attentive to inflation risk, signaling vigilance, commitment to reduce holdings. Okay, so overall, the statement leans hawkish is what they said. Let's go see. This was released on June 12th. We can check this on the Doxy and see how the Doxy reacted on June 12th. That was at 8:30 in the morning. Where's 2? Boom. And here's 2. So this is where the statement was released, and then we have a bit of a hawkish move here out of the dollar, which I remember this meeting very well. Now that I'm looking at this price action, because it was very surprising to us to have this. I was surprised at the dollar strength. Honestly, I didn't think the statement leaned hawkish enough to push it this way, but evidently it did. So yeah, so that's how I'm going to trade the FOMC tomorrow. I tend to not trade meetings or economic data with a sort of an anticipated outcome ahead of time. What I do is I create 4 different scenarios. So we'll go call it a bullish surprise, a bearish surprise, a as expected. Tomorrow can't really be mixed, but I'll tell you this 4th scenario, mixed. So what does this mean? For me, a bullish surprise out of tomorrow's FOMC meeting will be a rate hike. If they hike rates, of course, that's going to be a bullish surprise for the markets. Everybody's going to be like completely blown away by that. So I'm going to put this in parentheses because this is not likely to happen. And we'll also do this for bullish or bearish surprise, a rate cut, not likely to happen, but would be a massive surprise to the markets. I'll also do this. So Doxy buy. We'll call it equity downside, equity sells for the bullish surprise. And we'll do this opposite for bearish surprise. This is how I plan my scenarios for trading red folder news, including FOMC. As expected, hold. And then mixed does not apply to FOMC tomorrow. I'll touch on this in a second. So a rate hike would obviously be a bullish surprise. I'd be looking to get in on dollar buys. If you wanted to trade equity sells, you could. I'm not going to, but it's an opportunity I think that would present itself potentially. We're also in earnings season, so I tend to stay away from equities during earnings season. Yeah, so something that, the monetary policy statement leans hawkish. They say stuff like there's underlying inflation concerns. Some of the data recently has been making us think that, we're not quite restrictive enough with monetary policy, et cetera, et cetera. All that stuff would be a bullish surprise. The opposite would be the monetary policy statement leans dovish. So they'll be saying things like, we really love we're satisfied with where the inflation numbers have gotten to. We're starting to see some significant weakness in the labor market. We're aware of those risks. if they say anything about we decided to hold rates for this meeting, but are actively considering rate cuts for the next meeting, that would be very dovish of them. And then if they just come out and say, which sort of my expectation is, a as expected, beyond that, kick the can down the road verbiage out of the monetary policy statement. So monetary policy statement is totally data dependent. We want to see continued. We need to see continued. We're not quite satisfied with what we're seeing. We're not confident enough yet to begin talking about rate cuts, yada, yada, yada. Sort of my expectation, which for me, this is a no trade. And mixed data is a no trade situation as well. So take, for instance, Australian dollar CPI tonight. I'll do another one for CPI just because it'll make it a little easy. And then I think we got to call it here. I think I may be running over time. All right, so let's delete all this. I'm going to delete all this. Delete all this and delete this. All right, so there's more data that goes into Australian CPI. Give me 1 second. I got to see if I can find the highs and lows. Okay, so let me pull up this calendar here. So there's a difference between the data that we get when it comes to just Forex Factory versus a terminal like Reuters. So as you can see on this Reuters terminal, we have CPI, Australian CPI, quarter over quarter and year over year. We have the forecasted quarter over quarter of 1 and year over year at 3.8. Okay, so that is the forecast that we're seeing here on Financial Juice. For quarter over quarter, we're seeing 1, and for year over year, we're seeing 3.8. So that all lines up. Now, the difference here is, for those of you that know this, sorry for, going through this, but there is a range of forecast submitted by major financial institutions for what they think these numbers are going to be. And that range spans from 0.8 for quarter over quarter to 1.1. So for me, if we get a 0.8 or a 0.9 on quarter over quarter, it's going to be a deviation from the forecast, which a lot of the market may take initially and go, oh, we got a lower than expected quarter over quarter. Let's play pretend and say we got a 3.7. We got a lower than forecasted year over year. I'm going to start selling off the Australian dollar. For me, that's not enough. That falls inside the range of expectations. I'm not interested in trading that. And we'll see. We could see the market. The probabilities of seeing the market fade that idea are much higher when you have data that falls inside this range. So for me, we'll go 3639, 3639. So a bearish surprise would be year over year below 3.6, and a bullish surprise would be year over year above 3.9, and then quarter over quarter above, and year over year above 1108. 0.8, 1.1. So if I get year over year and quarter over quarter Australian dollar CPI above these numbers this evening, I'll be looking for Australian dollar strength. I'll be looking to buy the Australian dollar, which I believe, based on the current positioning of the Australian dollar, would be an insane surprise to the markets. Now, they are expecting a hotter CPI than previous. So it's kind of a little bit of a tricky situation here today, because we're expecting hotter than prior CPI. However, the Australian dollar is trading as though it's expecting cooling inflation. So that, to me, that sort of neutralizes the standing of the dollar and makes it attractive to trade in either direction. Like, my conviction as of right now is I would trade the Australian dollar in either direction. I would like to trade it, because of positioning, I would like to trade it as a bullish surprise more so than a bearish surprise. And then, as expected, would be year over year, anything between 3.9 and 3.6. So anything there would be as expected. Quarter over quarter, it's going to be between 1.1 and 0.8. And this is a no trade scenario for me. If either one of these scenarios comes out like this, in between these numbers, year over year comes out between these numbers, or quarter over quarter comes out between these numbers, not interested, no trade for me. Mixed would be if we see something like year over year comes out above 3.9 and quarter over quarter comes out below 0.8. We have one of them that is pointing in a bullish direction, and the other piece of data is pointing in a bearish direction. Another no trade scenario for me. There's always a way to create a bias out of this. You could say something like, well, year over year is going to be more impactful. So if this comes out above and this comes out below, I'm still willing to trade this as a bullish surprise. You could do that. For me, I tend to not do it because it just feels a little bit too much like a toss up. Oh, well, the markets, if it goes bearish, then in hindsight, I'll go, oh, well, the markets decided they cared about quarter over quarter more than they cared about year over year. Like, it's the edge there is not really definable for me, whereas the edge for a bullish and bearish surprise is much more definable, because it leans so heavily in one direction or the other. It's not like, well, I could make a case for both. If the Australian dollar comes out like this, the data comes out in a bullish surprise, the markets could go bearish. I'm not saying that can't happen. It could happen. I'm not going to get involved just because the data drops the way I want it to. I then need to see the charts start to react. So the data drops in a bullish surprise. If the charts drop down, I'm not getting involved. I'm not getting involved until I see the charts start to do something like this, start to fade that move back to the upside. So I need both the data and the charts to be in agreement. All right, let's see. All right, guys, I know you guys have a bunch of questions for me, but I think I'm running overtime here. I've run pretty hot for about an hour now. How when you know it is a buy or sell? Shadeen, I'm not real sure about your question here. Already people are pricing in BOJ hawkish news, and yen will become more bullish tomorrow is extremely important. Absolutely. I mean, people are pricing in the Bank of Japan news because of that headline that just dropped from the NHK, which is potential higher than expected, previously expected rate hike. Now, for me personally, just to be completely transparent with you guys, I don't trust anything out of the Bank of Japan. I tend to not trade any Bank of Japan news whatsoever. Once their actual policy stuff hits the market, cool. I'll take it into account into a bias for the JPY, but I don't trade any of their economic data. I tend to not trade their headlines. This headline could have been a tradable opportunity had I been paying attention to it, but I tend to not trade their headlines for long. I don't know. Japan is just a funny. They move very. Yes, BOJ likes to play the game, and I don't like to be a tinfoil hat guy, but I'm like, they mess around so much. I don't like to trade BOJ information at all, because they could do, they come out and they say this: Bank of Japan to consider additional interest rate hike. Okay, cool. And then when they actually hike rates, let's say they only hiked it 0.1% instead of 0.25%. Now the markets are going to be seeing, potentially seeing the hike as it's less than expected because of this new headline. And so now the hawkish outlook for the yen is challenged because the markets began expecting 0.25%. So even though the Bank of Japan hikes, we could see the yen fall. It's a mess. I don't like it. A Bitcoin analysis. As far as the fundamentals of Bitcoin go, I don't know. I don't understand Bitcoin enough to I'm not one of these, boomers who doesn't know what Bitcoin is. I know what Bitcoin is. I don't understand how it truly behaves fundamentally. So my initial thinking would be that it behaves similar to equities when it comes to, as far as its maybe it's risk sentiment. But again, I just don't know enough to really give you a solid answer here. Let's see. Let's go to the daily. Yeah, I wish I had a better answer for you here. June 12th. How did that react? Yeah. Sorry about that. Yeah, I could do technical analysis for you. Initially, just on this daily, we're in an obvious uptrend here, forming a bit of a channel. We're at the top of this channel range area. Zoom in a little bit more. We've got a level of support and resistance right here. Previous resistance, turn support. Will that support hold? Who knows? Another one here. Previous resistance. Boom, turn support again. Wouldn't necessarily want to get involved at these levels because you're buying into resistance, right? The ideal area would be to get in on some of these lower pullbacks, but it's just kind of one of those things where it's like trying to call a bottom here, maybe. Let's see. We've broken this lower low here on this leg, but I would say in order for me to feel like Bitcoin has truly turned bearish, we would need to break some of these levels and trade down here, because then I could see us trading lower for a couple weeks. But if we find support in here, or maybe even in here, I could see us going up and breaking these levels and then coming back down and retesting these levels before continuing up. Again, the Trump situation also may come into play with Bitcoin. He's coming out and being very vocally pro Bitcoin. So if we are starting to see, a continued increase in the chances and odds of him winning, that could play into the fundamentals of Bitcoin. But again, I'm not a Bitcoin fundamentals expert. I don't exactly know how this ties into everything. All right, guys. I know you guys have a ton of questions for me, and I haven't been able to get through everything, but I am going to go ahead and call it. I've been on for about an hour now, and I think everybody over A1 may have other things to do today. So keep your questions. I'll be back on Thursday, I believe. Let me double check. Yes, I will be back on Thursday at 9:15 in the morning. So I will see you guys on Thursday. If you want to follow up with me on any questions, you can hit me up on Instagram or YouTube or anything, and I'll try to get back to you guys. All right, from everybody here, A1, I hope you guys have a fantastic day, and I will see you all on Thursday.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.